NZDUSD is approaching a major liquidity zone, and smart money may already be positioning before the next expansion move. Welcome to today's Explainer. We're looking at the New Zealand dollar through the lens of institutional order flow. With a massive Reserve Bank of New Zealand catalyst right around the corner, the algorithms are prepping to sweep liquidity. We're going to dive straight into the charts and break down exactly how smart money is setting the trap.
Smart money may already be positioning before the next expansion move. Honestly, this concept dictates our entire approach to the markets. You know how it goes. The retail trader gets emotional. They trade exactly what they see in the moment, usually falling victim to FOMO, just blindly chasing the price. But smart money, they're incredibly patient. They actively distribute and push prices into very specific levels so they can accumulate at a discount before the news even hits. They don't react to the market, they engineer it. So our job isn't to guess the exact second the market moves. It's to map out these liquidity zones and simply wait for the institutions to show their hand.
The fuel for this kind of market engineering comes directly from the macroeconomic calendar. Right at 9 a.m., the official cash rate decision drops, alongside the RBNZ monetary policy statement. But the true volatility engine, that fires up at 10 a.m. with the RBNZ press conference. Listen, institutions don't just use these high-impact events to react to data, they use them to slip into massive positions by hunting and sweeping retail stop losses. The news provides the volume, but the liquidity resting on the charts, that's the actual destination.
It's absolutely crucial to see how fundamental expectations align with the technical landscape. Right now, the market widely expects the RBNZ to hold the official cash rate steady at 2.25% for the third consecutive meeting. But here's the thing, it's the forward guidance that really matters today. If they issue a dovish outlook citing economic weakness, we could see heavy sell pressure drive the price all the way back down to the 0.5800 level. On the flip side, a hawkish surprise, maybe pushing back against near-term rate cuts to fight inflation, sets up a clear bullish scenario targeting that 0.6000 psychological resistance.
Let's step into the technicals with a top-down structural analysis. Looking at the 4-hour time frame, we are seeing textbook bearish market structure. Notice how the market is just continuously printing lower highs and lower lows, and this bearish order flow is completely synced up across the 4-hour, the 1-hour, and the 15-minute time frames. More importantly, check out where price is anchored relative to the moving averages. We are firmly below both the 50 and 100 EMAs. They're sloping downward, fanning out, and acting as heavy dynamic resistance against any sort of rally. The structural bias here is overwhelmingly bearish.
Now we need to confirm this structural bias with momentum, rather than just relying on price action alone. Up on the higher time frames, the RSI is sitting at 44.8. This is a critical detail because it tells us the market is hovering near, but definitely hasn't plunged into oversold territory yet. There's a distinct lack of exhaustion here, meaning there's still plenty of room for price to drop. On top of that, the MACD signal lines are submerged below the zero line. The histogram is printing deep red and is pointing straight down. There is zero bullish divergence to be found. The momentum is aggressively favoring the downside.
Dropping down to the 1-hour time frame is where our institutional narrative really starts to build. Leading up to this current level of 0.58414, we're seeing severe volume contraction. The average true range has shrunk to an exceptionally narrow 0.00058. The candlesticks are just tightening up, the market is heavily compressed, basically holding its breath right before the 9 a.m. explosion. In institutional trading, extreme compression like this is the calm before the storm. Algorithms actively hunt for these low volatility pockets to engineer their largest expansions. It's literally like tightening a spring before a massive release of kinetic energy.
If you want to trade with smart money, you have to know exactly where the liquidity rests. Right now, we've got a massive pool of buy-side liquidity sitting perfectly between 0.5870 and 0.5880, right above those recent 1-hour highs. Why does this matter? Because this is exactly where the stop-loss orders of all those early retail short sellers are clustered. Institutions know this. They need those buy orders so they can execute their own massive sell positions without causing excessive slippage. This liquidity pool is acting like a magnet for algorithmic price action right before the true directional move happens.
And this brings us to a really stark contrast in market psychology: retail sentiment versus institutional strategy. Right now, retail traders see the bearish structure and they're aggressively shorting at the current price of 0.58414. They're reacting purely out of FOMO. But the institutional strategy operates on a completely different wavelength. Market makers know those retail stops are resting up at 0.5870. So the high probability play for smart money is to engineer a quick spike up, a liquidity sweep, to trigger those stops, trap the early sellers, and grab premium pricing before initiating the real drop.
Understanding this manipulation allows us to seamlessly define our execution framework on the 15-minute time frame. This is our kill zone. Currently, we can see minor rejection wicks at the lows, but the volume is virtually non-existent. We haven't seen a change of character, there's no bullish structural shift yet. The bearish trend is fully intact. What we're looking for is the news catalyst to suddenly spike the price up into our predefined premium zones, mitigating institutional order blocks right before the true sell-off begins. We don't guess tops or bottoms, we simply wait for the manipulation to play out right here on the M15 chart.
Let's map out the precise parameters for our primary high-probability sell setup. We're looking for an entry at 0.58650 that specifically sweeps the 1-hour resistance liquidity. Your stop loss needs to go safely above the highest structure point at 0.58900, and we are targeting the sell-side liquidity resting at the old 4-hour lows down at 0.58250. That hands us a very solid 1 to 1.6 risk-to-reward ratio. But keep in mind, the absolute strict confirmation requirement here is an M15 rejection candle, like a pin bar, closing firmly back below the 50 EMA after the news spike occurs.
Now, professional traders always have an alternative plan. What if the news drops heavily bearish right out of the gate, and we see a swift, aggressive drop that sweeps the sell-side liquidity at the 4-hour lows instead? Our alternative buy setup triggers if price sweeps down into 0.58150. Keep the stop loss tight at 0.57950, and we target a return to the 0.58600 level for a 1 to 2.25 risk to reward. The crucial confirmation for this scenario is a massive M15 pin bar or a bullish engulfing candle paired with a sudden surge in volume immediately following the release.
Precision requires absolute discipline, so we follow strict chronological rules of engagement. Rule number 1. Absolutely no entries before 9 a.m. Getting in early is quite literally gambling with retail money. Rule number 2. Wait patiently for the news to hit and watch it sweep the predefined liquidity pools. You have to let the manipulation happen first. And rule number 3, only enter when the structural shift and the candlestick rejections are actually confirmed on the 15-minute chart. This usually happens around 9:15 a.m. or just after the 10 a.m. press conference. Patience always pays.
As we step into this massive RBNZ catalyst, the ultimate question is, will you become liquidity or will you trade with it? Understanding smart money concepts isn't just about drawing lines on charts. It's about understanding the deep mechanics of institutional accumulation and manipulation. Wait for the sweeps, wait for the confirmations, and trade alongside the market makers, not against them. If you want more institutional-style market analysis using smart money concepts and ICT methodology, make sure to subscribe to the channel. And open your trading account using the link in the pinned comment to follow future market breakdowns and trading opportunities. Stay disciplined and trade smart.